Welcome all. It's a pleasure to welcome you to this final session of this wonderful conference. This is, as you know, the policy panel. And policy at central banks may mean a lot of things. For most people, it means just doing monetary policy. That's not what we're going to talk about today. In the research conference, the policy panel is going to be about research policy. And the idea is for us to have a conversation to get started off and then have a Q&A afterwards. The macroeconomy, as this audience knows very well, is a very complicated thing. And for central banks to be able to do good policy, they first have to have an understanding of what is going on and also an understanding of how their actions are going to affect things. And that's really not easy. We would like to think that a lot of central bank research is about that, but clearly not all of it is directly about that. And that's my first question. There are two kinds of research that goes on in central banks, those that are directly about the core mandate of central banks, and then things that may or may not have to do as much with monetary policy or policy in general. How do you see research at a central bank? And in particular, to what extent do you see research, in a sense, an expense that has to be allowed to keep smart people at central banks?
Many professions, when they want to promote the interests of the profession, try to paint a positive picture. So Refet is maybe being a typical economist by kind of focusing on a more negative self-portrait, like this tax on. So I'm going to be more celebrating the role of research at the central bank, but I would make a three-level distinction. So one, indeed, is direct to the mandate, applied, and a lot of work, super interesting work, is done here at ECB. A lot of it comes out in the economic bulletin. So those of you academics here, there are many boxes and articles published every 6 weeks, and there's a ton of interesting applications where you can see that kind of applied work. Then there's kind of a direct to the mandate, more blue sky, basic research. And let me maybe give you a couple of examples, which is interesting. So before the inflation surge, there'd been a project here called PRISMA, if I'm correct in the exact acronym, which is basically about the frequency of price adjustment. And when firms raise prices, what kind of increment do they use? When I saw that, I said, okay, that's super interesting. But inflation is pretty flat. How do we make use of this? Well, actually, even though it was not on the minds, I think, of the people involved who were doing pure science, it turned out to be super useful ex post to have this concept that we need the frequency of price adjustment can change. We need to think about it, and then we need to think about it also in terms of optimal policy. And maybe in between, because I do want to emphasize that some of this is theory and model-based, but we also, at the ECB, and I'm sure at the Fed and elsewhere, need to have a quantitative sense of how important different channels are. And so in a world where it turned out that the adjustment was nonlinear, it's also important that we have kind of people doing the time series VARs and so on, also doing nonlinear VARs. So all of that is to the mandate, but I think the way I would interpret more kind of unrestricted research is maintaining and developing the human capital of the staff. And who knows when that human capital will turn out to be important. Again, someone may spend their whole career not doing a policy role, but by being in the building, other people interacting with them, I think it permeates. I mean, I spent 20 years as a pure academic before joining the central bank. And I think that kind of investment in research, reading, writing, investigating, it's important as you go more senior in the organization that you have a fairly strong platform of having that real time in research, not just kind of browsing.
Fair enough.
Well, many of you probably read, but last May I gave a speech on the value of economic research and policy making. If you haven't read it, go find it and read it. But I'll kind of give you a couple of the key points that came out of that. When we think about academic style research or frontier research, what is the nature of that research? It's free thinking. It's thinking about things that haven't happened yet and trying to say, what if this or what if that? And we walk through models and what are issues you have to think about. The key thing is not time sensitive. The other thing we do with it is we send it out for peer review. We want to find out what the profession thinks and, to find out where it's wrong or it's made mistakes or how to improve it, okay? And that's a real critical aspect of it. When you do other types of like what I used to call directed research when I was the research director in St. Louis, that's very time sensitive. Something happened. They need some analysis of it right now. So it's quick and dirty. It doesn't go out for peer review. It's not forward looking. It's dealing with a problem that's happening right now. And when they have to do that analysis, what's the foundation for doing it? They're not inventing new theories at that moment. They're going on to the existing, typically academic literature and saying, what's been done on this? Okay, and that's what's important. So I'll give you just, a couple examples from like when I was in St. Louis. We had some people doing housing. And then people were like, why are we hiring housing economists at the Fed? We do monetary policy. 2007, 2008, what does everybody want to know about? Housing in the US. So all that work had already been done. It wasn't like we had to go do it. Same thing. We hired several trade economists in St. Louis. Jim Bullard, who was the president, looked at me one day and said, what are we hiring all these trade economists for? And then Donald Trump gets elected. And what happens? All of a sudden, trade, tariffs, everything is the question. We didn't have to go scrambling and look for new research or new ideas. People had already been doing it. So that's really the big nature of doing it kind of in advance. You've already thought about it before it ever happens. And the key point of all this is doing the directed research is exactly what we do. We do the academic research, we do it, and then when the problem pops up, we can put together a memo or we can put together a quick analysis of here's what we know from the issues. So that's the thing is we all do both. It's not that we do this type of work or we do that type of work. We do both and both are extremely valuable in a central bank.
I fully
Go
agree.
read the speech.
And bookmark this part of the conversation on your browser so that when you are pushed for more policy work at the expense of your research, you can come back and say, remember you said this. Excellent. The other thing that's interesting is the intersection of research and policy. And it works both ways. And I wanted to ask you, if you think about, for example, inflation targeting, that's an example of research chasing after the practice. QE certainly was, right? But there are cases where there are ideas that come from the research side and then feed into policy. Are there examples that you have in mind that you would say, we wouldn't have thought of this maybe, or the central banking world benefited from research in such and such ways, such that you were giving examples of trade and housing, but in terms of broader things in the policy framework design, the research actually fed into the way central banks operate, and that was good for humanity.
So I find it hard, but maybe that's just me, to think of research ideas that kind of purely originated in research. I mean, I think even the most abstract researcher is, inspired or driven by something. So I'm not so sure. I would say there's a kind of unidirectional move from research to policy in that sense, which might, if we talk some other policy area in the science, it might be, but in economics. But what I would say is when we think about monetary policy, the transmission of monetary policy, a lot works through how asset markets are set up. So these concepts of segmented asset markets, preferred habitat, the kind of balance sheet constraints on the intermediaries. And a lot of the history of those ideas were super abstract. So going from super abstract, and that's not, I never kind of contributed to kind of working on those. And I remember when I was doing my PhD in early stage, listening to people who are doing that kind of super abstract. Okay, that's super interesting, but I don't see it. I don't see the application. Whereas I think over time, indeed, as Bernanke said, QE works in practice, but not in theory. And to a certain amount, maybe the first wave of QE was more in 2000, in the financial crisis, was driven by crisis management. But then the pivot from crisis management to being like a stance instrument did build on essentially having to come up with kind of augmented monetary models with financial frictions, which is really the intersection of macro, contract theory, industrial organization. Many things came together. So I think, and then when we think about QE in particular and the kind of extracting duration and so on, the framework of Vianos and others on preferred habitat, I think turned out to be useful. And actually, I think, when we tried to calibrate QE and so, I think we got, reasonable outcomes on that. Let me emphasize, because I think it's been a comment I've heard both yesterday and today, is lamenting that the incentives are to work in the US economy because it's easier to publish. But I would say, when we think about the EU area, although, of course, balance sheet policies are used also in the US, the way balance sheet policies work in a monetary union of 21 sovereigns is different to the way it works in the US. And this is where, I think we've really benefited from researchers at the ECB and the national central banks, like the Bank of Spain and Bank of Italy and so on, and outside who've really thought hard about what does a monetary union look like. And Giancarlo today had the keynote. He didn't really do monetary union elements, but the work from 30 years ago and 20 years ago has really been important on that. So I would say, as Chris said, essentially, when you actually need to do something, it's too late to develop a new theory. You need the prior work, and that's really where there's a huge debt. Maybe totally underpriced. So maybe there's a massive externality from the academic research world to policy. Now, to some extent, we try and give back to that community, but maybe not completely. So.
Thank you. On that point of working on European questions, 2 years ago, a group of us, including Carlo Altavilla here, wrote a little, call for action that said, European questions are really interesting questions. We care about the people here. And unlike what people often assume, there's actually terrific data that allows one to answer empirical questions. Today, the data on banking and firms in Europe is actually significantly better than similar data in the US. And there's a lot of reason to work on questions that are dear to our hearts, and there is all the resources to do so. So, of course, ECB economists don't have to be told this, but for a broader audience, that really is an important avenue for research for us. One area of research that is really dear to central bankers' hearts is research that feeds into forecasting. And of course, we never get applauded for the forecast accuracy, and when it's not all that well, we hear an earful, as was the case in the recent inflation run-up. But forecasting inside central banks has its own challenges in that, as a central bank economist, if you ask me forecast inflation 3 years down the road, a very good forecast for me would be 2%, because I trust you, surely. That's not very useful, but it's not very easy for a forecast to be, 6%, where I'd be telling you, well, my guess about your monetary policy is you're going to colossally fail and inflation will be way above target in a long enough horizon. And that's a really difficult problem in that, from outside the central bank, forecasting is a joint exercise trying to understand what shocks will be hitting and how the central bank will be responding to these. From inside is the responder trying to decide. And that's at every central bank, it's a perennial problem, what the relevant baseline interest rate path should be. If one is to take optimal interest rate, then the forecast will always go to target perhaps too fast. If not, then what are we talking about? Is it the staff's way of telling the policymakers you're going to fail at your jobs? So research on forecasting is a particularly difficult exercise inside central banks. What is your take on, when forecasting works well, when research feeds properly into it, and in particular, how the staff's opinion of the monetary policy path should be thought of in a forecasting sense?
So I've always kind of had this view on forecasting that if you really just want a number at a certain point in time, to me, that's almost a purely statistical exercise. You take the data, you take the econometric model, whatever, and you just run it and find the best estimate for that number. Okay, that's great. And then when somebody says, and why? Now I got to have a model. Now I have to have some economic intuition. Now what you're doing is you're moving away from the purely statistical to having some economic content behind it. And then you say, well, wait a minute, there's a lot of anecdotal data coming out right now that's not in the historical data that might be telling us something. Well, now you're trying to sort of ad hoc that anecdotal data into the forecast. And that's where kind of the art of forecasting. So that's what I always try to tell people. If you want a pure, just accurate number, I can run it, but then don't ask me why I got that number. If you want some explanation, if you were a private sector economist, your clients would say, why? They want to know why. You don't just get to throw a number at them, they go, fine, take it. So I think that's really what we have to do too. We have to take the data, do this, put some intellectual framework around how to interpret that data, and then how do we bring in data that's outside of the model or outside the statistical model to help us shape that forecast. So there's an art to it. And if you get some part of it wrong, that's just the nature of the game. You're lucky if you can forecast well out past about 6 months. I honestly believe that once you get out to 6, maybe 12 months after that, flip a coin. I don't know what's going to happen after that. But I think that's always been my view of forecasting, is it's a combination of all these elements, and if you don't have it, the thing's not going to go well. So I'll just stop there.
Can I ask you what interest rate path you want your forecasters to use in general? A market implied path, or what they think is optimal, or what they think that you will be doing?
Well, I mean, you write down any kind of model which you're using. I mean, if it's not a pure statistical model, then you've got some framework. We have FERBIS at the board. We have some, economic model that's underlying it. And then you have to say, well, how's policy being determined in the model? Now, you can say, all right, let's just take the median of the SEP and feed that in and see where it goes. Or you can say, give me a Taylor rule of this form or that form and this form, run it through, and then tell me all the possible outcomes off the Taylor rule. And we do all of that. I mean, we do this kind of very broad discussion of how we want to think about policy. And then you're comparing to see, how far off would we be as the actual human making a decision compared to what a simple Taylor rule of some form would look like. So you're doing that to kind of check your own judgment about what I think the path would be. Is it way off of what some other model or Taylor rule would tell us to do? So, but what I don't want to do is go to the staff and say, all right, here's my belief on what I think the interest rate path is, plug it in, and then justify it. That's not the game you want to have. Tell me why I'm wrong. Tell me why there's a better path to do this. That's why I talk to you guys.
So maybe it's useful if I kind of complement that. So and again, the one difference is our staff publish the forecast. And so it's important to have a clear line of differentiation between the staff work and then the staff also advise, but in a stage 2. Given that forecast, stage 2 is also show me what happens under alternative rate simulations. And I think it's inescapable, the staff forecast. And remember, we alternate between an ECB forecast and a Eurosystem forecast, which is all of the 21 NCBs. I think it's inescapable that the market curve is going to be the curve underpinning the forecast. And as you said at the start, I mean, people need to remember always, it would be a problem if 3 years from now, inflation is not 2%. So either the market doesn't understand they don't believe us, so that is a problem. And in March, we did put out this tail scenario, this severe scenario where inflation doesn't, come back. But that's basically saying, but that's because, I think it was at the 95th percentile of the energy price distribution. So the market curve was not pricing us to be up there. But of course, if we did go in that direction, then the market curve would respond. So what I would say is, and again, I think now there's been a lot of work at the staff to develop these semi-structural models, which are a bit like FURBIS for the EU area. And that is the baseline. And as Chris said, you do need to be able to have a narrative. So when I see the forecast in presentations, it's basically, here's the shock decomposition, here's what's driving it. But let me come to the add-on, the judgment, where again, for us, it's staff judgment, whereas I presume with the dot plot and so on, it's each of you on the FOMC is free to play around,
Yeah.
But for us, we're looking for the collective judgment of the staff. And what I would say is it's very important to us is the staff can stand over that judgment element. And that's where all the other models, the satellite models, essentially, many say there's some kind of nonlinearity going on, or there's some reason the traditional elasticity doesn't work. But then the staff need to say, well, we've run this satellite model where we allow for the nonlinearity, and that means we're pushing the overall forecast by X. I think there's some work we published here at the ECB 2 or 3 years ago, which basically says judgment at the ECB tends to be in the right direction. That's reassuring.
At least it's going in the right direction.
So it's not random, and that's very important because, as you say, if we just take the basic model and run it, it doesn't take once the model is built, it doesn't take too many resources to press the button. So it's the extra, it's the building the narrative and doing that kind of sensitivity to alternative satellites is important.
Yeah, I just want to follow up. The anecdotal evidence and real-time data is really, really valuable for where we do these exercises. I'll just use one example for my own past, and that was back in 2021 and 22. Inflation was starting to take off. There was this thought we had to start tightening policy soon, and everybody's like, oh, if you tighten policy, you're going to crash the labor market. That's what a standard Phillips curve is going to tell you to do. And I'm sitting there going, wait a minute. When I look out there in the U.S. right now, there's 2 openings for a job for every person looking. Why would people suddenly start firing their workers because I raise interest rates when they can't even fill the jobs they've got? So, and every firm I talk to would say, so if we raise interest rates X, what would you do? Would you fire your workers? No. I spent 3 months trying to hire this person. I'm not going to let them go because interest rates went up. So I kept hearing all this anecdotal data. So when we started raising rates, every model that we had said, you're going to cause a recession. Unemployment's going to go, I think Larry Summers said it was going to go to 9% for 2 years. And I'm like, I don't think you're looking at the same anecdotal data I am. And so I said, no, I don't think that's the case. Well, that worked out. But if it hadn't been for all this anecdotal data being told, I'm not laying my workers off, the model would have told you this is the cost of doing that interest rate policy. So it's kind of taking that stuff, putting it into a model, trying to think through, and I did this whole beverage curve argument. But it was, again, trying to think of a model that matched what I was hearing and how it would all tie together. So that's really, I really am a big believer in how, if you get enough anecdotes, you tell yourself that is going to be the data in the future. It's an anecdote now, but it will be the data in the future. So use it now and don't ignore it.
I think that's a very powerful example, but let me also emphasize, I think it's true for us, maybe it's also true in the US system, there's also people come across an anecdote and they say, oh, this is really concerning me. And we hand it over to the staff and say, okay, the mechanism exists, but actually it's going to be nearly invisible in the macro data.
Yeah, quantitative.
You know, so in the sense of that, that's also part of it is the negative role of kind of research is basically to kill bad narratives. You know, so what Chris said was a very powerful narrative, but you know, every so often, and I'm looking at staff members who probably might agree with me, occasionally you get bad narratives, and the role of the staff is say, okay, we're not saying you know it doesn't exist, but quantitatively, don't worry about it.
Yeah.
This discussion about anecdotes and judgment actually relates to what we were talking about earlier, in that, in particular, if you need judgment, you need people with good judgment, and that's where, you know, having the good researchers with the good human capital really comes in. On the other hand, if you're relying so much on judgment and anecdotes, you know, all these modeling exercises are perhaps not as useful as we would have hoped they would be. So I'd like to come back and ask about that. You know, when thinking about, for example, policy counterfactuals, not forecasting, but the counterfactual where one has to have a theoretical framework, has to have some model so that the counterfactual is meaningful and consistent. How often do you find yourself saying, okay, you know, we have all these models inside the building and they give me these counterfactuals and I'm happy with that, versus saying, well, and then I have to push the staff to exercise judgment or have to add in my own judgment, perhaps more often than you would like to?
So on counterfactuals, I think where the anecdotes come in, and also it's possibly sometimes not the same people. So the people who are the model builders may not be the people who are going to some OECD working group or some, you know, doing some market intelligence, which are coming across interesting issues, let's say about the energy market, that here's something going on which you really need to know. So I think in specifying the counterfactual, there might be temptation by the pure researchers to go for what they know. For example, in a lot of cases, I think we had it this morning a bit, it's a lot easier to do a temporary shock for stability reasons. But actually, I really want to know what happens if this is a permanent shock. There's a level shift which is not going to reverse. And that can be annoying for researchers because it's not so easy to do. But from the point of view of a... So there's probably some push and pull in terms of what goes into it. I think also there's a temptation, I think sometimes, to do things one at a time. But in the world we live in, let's say the tariff shock or now the oil shock, there's other things going on. And if you really want to kind of get to a policy relevant answer, if you say, well, here's what I ran, okay, but maybe you want to think about, has there been also at the same time as a tariff shock, a risk aversion shock in the financial system, or what have you. Or going back, quite often there's an endogenous fiscal response. So again, it's more work. So, you know, I think, remind everyone who's from the outside world who says, please publish more scenarios. We're kind of curating the scenarios because just kind of bombarding you with, I mean, the information in the published scenarios is, why did we publish these scenarios? What made us, because of course we can run many things. But I do think scenario analysis is important, but for any given scenario, looking at the sensitivity around it, and maybe since we're talking about it, one thing that's, I think, important and is developing is also giving a sense of the likelihood of different scenarios. So if you tell me, well, you know, here's a scenario, but by the way, historically, there's never been any episode where output and inflation have co-moved in that way, versus, well, actually this, because if you look now, people say, is this like 2022? Is it like 2011? So combining the scenarios with kind of, okay, here's a matching or kind of a propensity matching type thing where this looks a bit like some previous episode, can help various people understand what's going on better.
We're coming to an end of a almost 2-day wonderful conference, and very oddly, the topic of AI hasn't come up yet. So we're gonna correct that wrong now. And I'd like to ask Chris about, to what extent one might or might not want to allow or encourage using AI in central bank research, in the sense that you very nicely articulated the point that when you're scrambling to do policy, you don't have the time to do research on it. But perhaps, given the new technology, we are able to produce research much faster than before. On the other hand, maybe we don't want to produce research that fast because we want things to be tested properly before they are used for policy. What is your view on using AI for research purposes at central banks?
Well, I've always viewed AI as a tool. I tell this to everybody within the Fed, whether you're a researcher or not, it's a tool to help you be more productive. That's it. We're not putting it in to take your job. That is not our intent. We want you to do your job more productively, more efficiently, so you can take your time and do other things of higher value that you were constrained before. And that's really kind of the key thing. Now, in terms of research, within any central bank, what data and information are you going to feed into this thing? And that's very sensitive, right? You don't get to just put anything in you want. You also don't get to just run some output and then copy and paste it into something. Hey, I came up with this great piece of malware. Let me see how it works on the Fed system. No, you don't get to do that stuff, right? So there has to be guardrails on what happens. So we make sure that this stuff doesn't get out, or if we use inside information, it's not somehow used or helping the companies use our inside information to develop their models. That's just a risk management problem for most of what we have to do. So I know at the Fed, we've built a sandbox where we have a bunch of different AI models that are provided to us from AWS through the cloud. We have some guardrails. We may not have the most up-to-date, cutting-edge model because we had to kind of check through and set things up. So that'll be the one cost to the researchers. You may always be a little bit behind doing your work at the bank, but that's the risk we have to protect against it. Other things don't happen. But I think it's an amazing tool. I would like, in situations like you were describing, if you just want to summarize the economic literature on tariffs and, let's say, inflation, sounds to me like this would be a perfect way to have AI generate a summary of all these things. What are the key things? What are the key findings? And we don't have to waste economists' time for a week digging through journals and trying to summarize it and type it up in an Excel spreadsheet. That's what I see it as very useful for. We do things like our meetings. You have transcripts of the meetings. If you wanted to do an executive summary of the whole meeting, run the transcript through. It gives you an executive summary. Very fast and efficient way to say, do the minutes of our meetings. There's lots of really nice ways you could use this stuff in a central bank to make us all more efficient. But like I said, in terms of research, you're going to have guardrails on it. We're probably not going to let you sit on a plane and run stuff on your laptop that has sensitive policy information on it. They won't even let me use it to clean up my email. My email, nobody gets to screw around with that because of the stuff that's in there.
But I mean, quite similar observations, but what I would say, I mean, going back to the idea that part of what people do is research for external publication. And of course, now with all of the different ways you can improve your, I mean, if it's going to a journal, it's already got to the point where it's kind of safe information. And there, because I think probably there might be, historically, maybe at management level, okay, they've written the paper, it's 95% going to remain that paper, but it takes so much work to go from 95 to 100 to get it into a top journal. Do we really want that guy spending that time? Whereas I hope that revision, polishing, with these kind of agentic referees and so on can help that. But going back to, I mean, you framed it as rapid response to an emerging issue. I would hope the staff have the imagination to say, okay, yes, I'm more productive. Let me build up my library of all sorts of different scenarios. I mean, I saw something on, I think, Tyler Cowen's marginal revolution thing the other day. We're saying, like, the future of a paper is basically it's going to be a portal. You've got the paper, and then it's like a Q&A, saying what happens if X and Y. And the more you can turn your paper into a product. And this happens inside, I'm sure it's inside, in the ECB, a really successful project is it goes from being just a paper to being in the toolbox, where you can press a button and you see the updated estimates. You can press a button, and so already, because the pressure from policymakers means people do want to make their research useful. But I would guess more generally, that's where AI, like that annoying, step from having the basics to having a polished interface for other people. So I'm very positive also on how to, making everyone more productive. But probably means a two-layer life as a researcher. The inside layer, where you don't want things to leak, and you may have to be at a kind of lag, versus the outside layer, where you're just part of the global research community, and there you can, on your home computer, go to town.
I love this idea of just have the paper be the engine.
Right.
All those referees that say, well, do this robustness check or do that one. You say, do it yourself.
That's always referee two.
Do it yourself. It's right there. Click the button. Don't make me go do it.
Before we turn to Q&A, let me see whether I can get a research mandate out of you too. On, given the policy problems you're dealing with now, what are some of the things that you wish somebody had done the research already on these things that, such and such questions would be answered by now?
Yeah, I mean, just thinking of something right off the top of my head that we're dealing with at the board, and some of the staff that are here, they can. But one of the things that you're sitting here and you hear the following: the Trump administration has a big deregulatory agenda. This is going to unleash growth on the economy. We're going to eliminate 3,000 regulations that are all very micro-oriented. All right, now how do I plug that into a macro model? Right? It's easy to say, take this regulation in a micro thing on one particular thing, but then to say, take several thousand of them, put them in. Are they binding? Are they not binding? This is back to Philip's point. Quantitatively, are they big effects or small effects? But that's kind of what we ask staff at times to do, is how do we think about putting in a massive deregulatory policy into a macro model to spit out what it's going to do to economic growth, inflation, deflation, whatever. I mean, it's not an easy question, but it's kind of a question that policymakers need to do. And I know staff from the board that are here, people are working on that, trying to figure out how to do that.
I mean, clearly, structural reform has been a topic in Europe forever. And there was, 10 or 15 years ago when Europe was trying to get out of the crisis, there was interesting work both here and actually in the Federal Reserve System asking, indeed, can you get front-loaded benefits? Because structural reform as such, in an annoying way, show up in productivity and growth 5 years out. So from an election cycle point of view, 5 years out is a bit frustrating. But in many macro models, you should get a front-loaded response because of anticipation effects in terms of consumption, asset prices. Now, part of this, showed up in monetary policy, the forward guidance puzzle and so on. Why do people discount the future so heavily? So I think there's an interesting issue about, on the one side, the productivity type effects, but I think it's everywhere right now with AI, with lots or structural reform, anticipation of future productivity. When you then layer in uncertainty about, you may say, well, in the aggregate, the economy is going to benefit. But I'm not so sure I'm going to benefit because the churn involved with structural reform means my particular occupation or my particular industry, also for AI, means there's more uncertainty. I think both now and going back over the decades, there's been a lot of work on this, but it is a super interesting topic. And maybe I'll just mention, because again, financial intermediation is obviously for transition quite important. And the world we're living in where, digital finance, lots of changes in the structure of the financial system, is again somewhere where there's kind of interesting abstract work about what does it look like, but trying to map the financial system we see to the concepts we can model is an interesting challenge.
Thank you for that. That was wonderful, and we have some time for Q&A, and it's not always that we get to talk to two people who are themselves so much into research, have done it, and therefore are able to appreciate it, and are now doing policy. So, the floor is open, and let's begin with Anna here. And a microphone is coming your way.
Hi, Anna Lipinska, Federal Reserve Board. So I wanted to ask you about organization structure, like between research and policy. So we have, the board representative and ECB representative. At ECB, you have a dedicated, directorate for research. At the Fed board, we don't have a research department, but at the same time, there is this view that, everybody, every economist has time both for policy and research, and in order to do research of quality, you have to be exposed to policy firsthand. So can you talk about advantages and disadvantages of each of the system, or what should be the optimal system, or maybe it doesn't matter? So just wanted to hear your views about that.
Yeah, when I ran the research department in St. Louis, this was always a thing. Should we have people dedicated to the policy stuff and then pure researchers? And I kind of gave you my directed versus academic research answer in the beginning, and the answer was, you do both, right? And if you're on the policy side and something comes up and you don't follow the academic literature, you don't know what's going on. If you're on the pure academic side and something policy, and you're like, I have no idea. You pop your head up once a year and look around and say, what did they do? It doesn't, then you're kind of so far out of it, you're not helping. But on the other hand, there's long this kind of argument, why don't we just specialize? That's what economists like. You specialize in this, it's more what your interests are, I'll specialize in that. And if we both specialize, we get a better product at the end. So I don't think there is a right answer on this. It kind of depends on what you want your people to do. And your models will attract certain economists or not. But I always preferred the model where you had to do everything. It kind of made you more knowledgeable about policy, and it also kept your foot as a policy person in the academic world. That's my thoughts.
I think if you do have the system we have, where there is a standalone research group, it's not going to happen passively that the right amount of interaction between research and policy takes place. So here we have a system of research clusters, which brings together the people in research, but also there's a lot of research done in the business areas. So it's important to actually do the effort, which Luke and his team have to put together, of having these clusters so that people know, and it's one building, big building, but the culture has to be, and the culture has to be from both sides, that it's expected and encouraged that you get to know the people who are doing the counterpart policy work to the research you're doing. Mobility, where possible, and we actually have right now there's some rotation between research and some of the policy areas. So people in the end, I hope, know they're working for the ECB. And the organizational chart is secondary to the culture. And again, I would say, if you're a researcher, I hope you really want your research to not only be published, but to make a difference. So I think that there's a lot of incentives already to make sure that the information and the effort flows in both directions. It's a good question. Yeah.
I would say it's also important to be able to make exceptions for exceptional people. Right? Even in a system like the Feds, where everybody does research and policy, every now and then you get someone who really doesn't want to do policy, but is the kind of person that Phil was talking about, the kind of person you want to have in the building because that person is useful to others. Someone who's an expert on solution algorithms. It's important that one is able to carve out a position for someone like that, where you get to tell them, okay, you're less of a policy economist, but we think of you as a plumbing person here, and we'll let you do your kind of thing because having you here is useful.
Yeah, I've always been kind of opposed to that because then it's like, well, that person's special. Why am I not special? And then who gets to decide who's special and who's not special? You all get treated the same. That's always been my rule everywhere I've ever been. If you really need somebody that specialized who doesn't want to be in policy, bring them in as a visiting scholar. You don't need to hire them. Just tell them to come on in for some period of time and then interact with them that way.
Yes, ma'am.
Philippine Corsiman, ECB. I would like to draw on your discussion on AI and the use of AI in research. And let me share just one intuition, because coming from the, looking at the US subprime crisis, then sovereign debt crisis in the euro area, we would not have found in the books or in any place or in the internet the mechanisms through which were developing under our eyes. And when we were doing market interventions, the first days in May 2009, after the weekend, I had to write the rationale for the ECB on why we do that. There was nothing in the books. There was no mechanism, no transmission mechanism where the role, or no model where the role of government bonds would be set for market liquidity, for transmissions to interest rates, and so on. So I see the risk when we do use AI. It can only be based on available information past, like DSG models were based on past developments, and we relied too much on them. So when the crisis happened, we were like abandoned by what we had been doing in research. And so I would think one analogy I find here is in the same way as we had too much reliance on our linear models and knowledge and DSGs and so on, we didn't look at the not likely or very little likely scenarios, and then happened the crisis. With AI, AI is by design based on the most likely. So maybe there is some analogy to do on what that means also for careful use in research.
Maybe I'll respond, because I think it's a super revealing example where essentially, actually, I would flip that around. So humans in the central banking community might have had too narrow a focus. But when I think about the economics literature, there's massive amounts of work on currency crises. Massive, so in other words, there had been plenty of financial crises before '08, but they were in emerging markets. And so the AI might actually have seen beyond the narrow focus of the European Central Bank economists and said, well, actually, when I look at the whole corpus of the academic literature, I see that. I also see the kind of Diamond Dybvig kind of bank run models. And in fact, this is an interesting issue, because I mean, the BIS now has this online time series tool, which basically, if you hand over like how to forecast inflation, in the paper explaining this tool, they say actually it did a better job in the inflation surge, essentially because they had a much more open mind about the priors than someone who's kind of schooled in it particular. So actually, I would turn that around, Philippine, and say, this is actually maybe, and I'm sure it could be done actually, if you stop the AI learning in 2006 or something, and say, and then you go through the scenario that actually happened in August '07 or March '08 and so on. That could be an interesting test. Would it have actually revealed a lot more? So I'd be hopeful the wide lens of AI might actually be more helpful than you might indicate.
Anton?
Anton Nakov, ECB. How do you insulate researchers from pressure to produce research which is supportive of existing policy positions?
I don't have that problem because I never tell them to do that. I usually ask them, how can you help me come up with a framework that makes some sense of what I'm trying to say? I mean, that's what I did with the beverage curve, talking to Andy Figuera. I had this idea that there were all these vacancies. I was just thinking about supply and demand. You got demand way outstripping supply. There's all these vacancies. You can push down the labor demand curve and get rid of all the vacancies, and employment's determined by the short side of the market. And then Blanchard says something to Jay Powell about, yeah, you can't do that. There's this thing called the beverage curve. Shit. Oops, sorry. So then, we start talking to Andy, and it's like, no, this all makes coherent sense. It's just, you're on this really steep part. So it was like I had this intuition in my head, but I didn't know, just supply and demand wasn't cutting it. So then I was trying to figure out, well, how do I want to think about this? And the staff helped me, not that they were trying to justify it, but give me a framework that it made sense as opposed to it just didn't quite work. So I don't say, here's my view, give me the model that justifies that view. But is there a way to make sense of what I'm trying to say? And if they say no, sorry, then you toss it.
I think I have two answers, Anton. One, it's important of the governance, because it protects the staff and protects also the policymaker if basically there's no sign-off of working papers and so on. So basically, and I'm sure there's a disclaimer that it's the work of the researcher. So that is one. But I would say, if I read something and then someone, this is more of, I think, probably an academic might do, or a student would say, and now here's the dramatic policy conclusion coming from my model, because they're trying to maybe amplify what the model says. Whereas, if there are policy conclusions saying in the context of this model, so just being, for me, a bit low key, because no model is going to capture everything. So I think it's robust to say in the context of this model, the policy implication is X. You don't follow that sentence by saying, and therefore, the ECB is totally crazy or whatever. It's to be scientific about it as opposed to, because so that's what I would say is it's important to spell out, but most results are, there's a model specific element to it.
Thank you. Yes, please.
Matthias Meyer, University of Mannheim. Mr. Waller, you mentioned hiring trade economists, hiring housing economists, when that was not, those topics were not part of the policy debate, and it turned out to be a type of precautionary measure. My question to the two of you is, which subfields of economics do you consider precautionary? Do you consider a good subfield to hire for precautionary reasons? What may be the topics of the future?
Yeah, we've struggled with this, within any, like when I was research director, you have so many slots in your department. You got to kind of choose, do you want to have more in one area or do you want to have more breadth? Those are trade-offs you have to kind of make. I always kind of said, look, I don't really need any health economist at the Fed. It's not that this isn't important, but the health stuff is a much more longer demographic trend, and I can get scholars in to visit to talk, but I don't need to hire like a health economist. I don't need to do anybody doing field experiments, putting up mosquito nets in Africa either. I'm sorry, that might be really cool, but it's not really that relevant for what we do. But then you have to kind of think, so like the housing one, well, what's one of the main mechanisms for monetary policy? Interest rates and housing. So maybe that's not so far-fetched. Trade, we don't do as much with exchange rate control in the US, but you'd have to understand how this works, and exchange rate stuff is always floating around in economics. So again, there's a tie to it, but it's not like every day in the Fed we sit and go, okay, what's our exchange rate policy gonna be? We don't talk about it at all. So I always try to think like, what is it that gives me some value that's on the edge, but it's not too far off that there's no point in me having people in the department providing me that kind of research.
Let me add on. I do think, there's some very good work on international macro at the ECB, but I think Europe is shrinking as a fraction of the world economy. So in terms of the origin of productivity, you know, a lot of productivity, which is, you know, driving trend output, is going to be global. So understanding how the world fits together, even before you get to policy questions like tariffs or FX intervention, just understanding, if I want to understand what's driving the European economy, I think, you know, global trends, global shocks are very important. And it is there, but you know, I'd like to see it more mainstreamed and more people working on it. And that is a field that's not so big. So, and it's difficult. It's a difficult field.
We can take a last question from Professor Dr. Guido Ascari, who is himself an academic and a research director.
Yeah, no, thanks a lot. Very insightful. So I cannot get away with this sensational, with this feeling. You get two extremely good researchers that who actually happen to join policy at a very high level, and we got a bit of preaching to the choir here, right? In this sense. So let me try to shake you up a little bit, if I can. So
we're really good at not getting shaken up, Guido. That's what's the criteria for getting the job.
So during your experience, right, your experience changed the way you're thinking about research, or you have been thinking before you joined, and about the usefulness of research. And second, in your role, in your boards, did you interact with people with every different background for yours that maybe think about research in a very different way, and also about the usefulness? Can you get any example, if you want, in which you had to stand up for a researcher, for research, or for the research culture in your organizations, some way, in some sense, in your interactions?
You have an answer to that.
Well, like I said, I've tried in the speech I gave last May, when there was some political criticism of economists, and particularly economists in the Federal Reserve. I was trying to say, look, this is their value to us and what they do. And we need that. We need that both. And it's not that people are off doing airy-fairy stuff. It's just that stuff suddenly becomes important one day, and we don't have to go redo or invent the wheel at that point. We rely on this. I think Philip said you're this set of human capital, these walking, talking encyclopedias that you may never pull this book off the shelf, but one day you're like, I got to know everything about that topic, and I'm going to go over to that person on the staff. And I think that's a little different from like even when I ran a reserve bank. The board staff is big because there are these minutia kind of topics that we need people to have very good understanding. You may never talk to them in 10 years or 15 years, but that one day when you need an answer to something, they tell you, go talk to X. So I've always felt that I can't do my job if I don't have those people. I can't go out and talk. I can't go out and address questions from the public and give them coherent answers if I don't have the staff behind me backing me up.
So what I would say in terms of the role of research is there's definitely a science to monetary policy. And this goes a very long way in helping us make decisions. But there's also, an element of an art to monetary policy as well. And so it's important, I think, to for those who are not coming from a research or background, to preserve that space. To say, well, so if you take the rates, the staff do these rate simulations, but they are model-based, they're model-specific. But of course, when you get down to the actual decision you need to make, all sorts of factors go into that, and to essentially preserve the room and the kind of space for the policymakers to recognize, okay, in other words, that the science does not dictate the outcome. There's not a unique answer from a policymaker point of view. And I think, even within the category of rate simulations, there's choices you make in how to do those rate simulations. So recognizing where the limit is for research, and then where the policymaker who has all sorts of perspective comes in. What I would say, and I don't think it's in the central banking world, but there's a whole narrative out there about models. But the people who know the weaknesses of the models the most are the modelers. The people who actually do the work. They're the ones who really, I mean, I once wrote a letter in the Irish Times decades ago. Someone had this comment. I said, look, it takes about a day to learn the kind of first welfare theorem. In the sense, here's the conditions in which everything is fine and the free market creates the efficient outcome. The rest of your degree and your postgrad degree and your doctorate is all the deviations from that. So the idea of this caricature that models are kind of idiotic, basically. I mean, it's such a, it's not true. So there's probably, again, not so much, because everyone involved has an appreciation, but to the external world, saying that there is a basis for, and what I think I would try to encourage here, and you see it, a lot more of the detail of the models are being published in working papers. There's a lot more disclosure, and the more people can see what we're up to, it has that external challenge, and it helps the analysts out there who have to track us to understand better the models that we're using.
Super. It's actually surprisingly rare that the two sides of the Atlantic get together to talk about stuff, where stuff isn't some immediate policy concern, but how things are going, how we are handling various concerns, how we're thinking about policy frameworks. This conference series is probably the flagship event that does this for central banking. And the people who started this in 2002, I'm sure they're proud to see that after almost 25 years, it's going strong. And we had a wonderful 1.5 days talking about research and central banking and monetary policy. So on behalf of the organizers, thanks you to all of the presenters, all of the contributors, and all of the audience. And special thanks to our hosts at the ECB who've really taken very good care of us and made sure that everything worked excellently. And special thanks also to the two greats here who spent their time talking to us about why what we do is worthy of doing. Thank you so much.
Thank you.